Mr. Speaker, ladies and gentlemen, we live in a very volatile and ambiguous and complicated world with a lot of systemic risk. That's what we saw happen in US banks such as Silicon Valley Investment Bank during the pandemic, and the other aftermath of wars in Russia and Ukraine that led to the inflationary environment we're in right now. This debate is about where we can best protect people's hard-earned money, protect people's investments, and create an incentive structure wherein banks are able to be there for their clients. Now, an important piece of reframe is to really understand how these things work. Because oftentimes, the bank is one institution, but this insurance can be mechanized in one of two ways. One, it could be through a government fund, either through collected taxes or maybe from a salary deductible premium that they take from your salary every month, if it's like that in your country. Or two, an insurance agency who's third party, who charges you a premium on a periodic basis to be able to cover that and give you a sum of insurance. So this debate is about whether or not we should mandate an increase in this particular limit to be able to protect people and protect their investments given an inflationary period and given the fact that there are many things that can go wrong in the market. I'm doing three things in my speech. First, I'm going to run a vertical and horizontal extension on how banks work in status quo and the involvement of insurance agencies and how these plans work and how that affects the premiums you pay, something which opening teams didn't get to talk about. And ultimately, I'm going to run an outcome-independent analysis of interest rates and money supply. So, ultimately, we have to understand that interest rates and money supply are somewhat related. Meaning, if you have more money supply as opposed to the demand, it's probably going to be inflationary because the money is going to be worth less. So, at the point in which your money is worth less and the market kind of sucks, you can invest in things like fixed income or bonds, which are probably going to be good for you given that inflation could probably be peaking at that particular point already. Or a point in which, for example, that let's say money supply is, for instance, shrinking because we're in a bull market or things are looking good, then people can invest in things like stocks or index funds or exchange trade funds, both of which are funds that banks actually sell to their clients, like a fixed income fund or an ETF or a mutual fund for that matter. So this is an outcome-independent piece of framing that actually knocks out a few things that we get from opening because there was sort of this deadlock about what happens in an inflationary environment or what happens in a deflationary environment. Moving on to some responses before my case, a bit extraneous ones. Firstly, Elo talked about how it's more expensive to bail out client funds if you have a higher deposit limit, meaning the literal sum of money is going to be bigger when you have a higher limit. Yeah, that's true, but that's the point of having an intermediary, like what I characterized earlier. Whether that intermediary be a bank or whether that intermediary be an insurance company, the nature of those business models is that they have to arbitrage or hedge risks, meaning the reason why insurance companies exist because they assume that not all companies are going to go bankrupt. So if you're maybe like a chaebol company like Samsung or all these big Lotte World and stuff, these big consumer-driven economies, it's probably not going to go bankrupt. But in instances, for example, where you're a mom and pop shop or you're an SME that's very speculative because you invested in, I don't know, AI or crypto, then you're the ones who are going to be at risk the most. But the nuance here is that we need to be able to take care of these particular individuals, and we think that the trade-off we're willing to take is that the insurance premium is going to go up. Because you can't have your cake and eat it too. You can't have big coverage but cheap insurance premiums. So just to clarify, the insurance premium in my definition is just how much money you're going to pay on a periodic basis to be covered. Because in the Infoslide it says that the bank pays it, but they're probably going to transfer that to the consumer anyway and charge it from your account, a transaction fee. So the point is just that if you want insurance to be better or you want to be covered more, you got to pay up, and we think that governments should be able to have that, and that's why this value judgment debate is going to be better off in a world when we push this to happen and South Korea banks allow that to happen. Now, secondly, opening also asserted that, oh, when you have more supply equals lower interest, rates are going to be more competitive, and ultimately there might be an immediate exodus of capital that might happen. So for instance, let's take a look at a scenario. In a Korean bank that has a higher insurance limit, there might be a 1 to 2% haircut in your interest rate offered because they have to make up for it. But as opposed to, I'll take you in a bit, like a Vietnamese bank, for instance, who has a lower interest rate but a lower limit, then I guess you have to make that decision. It really depends if you're risk averse or risk leaning. They can make that decision, and we want to give the market a chance to make that decision depending on what they think is good for the risk profile. Yeah.
You say that insurance fee is definitely going to go up. It'll be likely to compare to like individual depositors. If the barrier to deposit goes up, wouldn't it be bad for people, like intuitively?
Yeah, it's gonna go up, but I think paying a few hundred, a few thousand won on a periodic basis, which oftentimes can be spread out, is not as bad compared to your hard-earned money you get, which actually compounds when you invest in these particular investments. When you invest in the stock market, an ETF, or a fixed income fund, I'd rather pay a bit more for that premium and be protected. So ultimately, what have we talked to you about, right? I essentially ran to you a few things already. First, I ran to you this idea of exactly why these things are going to be better off. And we think that it's going to be better off for the average person because the average person is the most affected by inflation, and ultimately the fear of banks and systemic failure is going to target them the most, something which their side never super talked about. Secondly, this is an important piece of nuance and argument, is that it promotes financial literacy among young people to be able to have enough money for their retirement and ultimately not be reliant on government pensions or other external forms of relief. Meaning they don't have to work too long when they're actually retired and take different odd jobs which are often manual labor, or ultimately they aren't mercy at the state who are ultimately going to have to take care of them. That's a tie back to South Korea, and a tie back to why it's in the interest of the government to actually have this policy. Because in a world where these banks are able to have an incentive structure set, where you can have a higher limit, there's less stress on the government to have to be able to take care of them in the long run. That's something that they want to do, and that ultimately allows them to compete with other markets, for instance. Other countries like Vietnam and Indonesia and the Philippines, something of which is in the interest of South Korea to stay relevant. It's my first time in Seoul. It's an amazing place and ultimately much better than my country back home, to make that comparison. And the only reason that they got here was because they were at the forefront of innovation, and ultimately that can best happen when people feel safe, and ultimately the best people's money can be best secured and protected in order for it to be used in the future, because banks invest in different things to be able to take care of you. It's a win-win situation. Thank you.